Before I start, I'd like to say a quick thank you to our sponsor, Fidelity International. You can find out more about them at fidelity.co.uk/money to the masses. Hello and welcome to Damien's Midweek Markets, the show where I talk about what's going on in investment markets and what to look out for in the days and weeks ahead. Now, at the moment, we never have a chance to get bored with what's going on in investment markets. We seem to always have something different happening, and with the volatility where it is now, there's always something to talk about or watch. Now, since I made my last video, we're at a point where I'm checking now. The S&P 500 is up about 2682. The FTSE 100 is up towards 5642. So we've had the markets rally strongly, and it came off the back of a rally at the end of March that bled over into April and has continued. And what we've had is we've had markets almost coming back out of that bear market definition, so they're no longer below 20% below their highs of February. And at the end of March, a lot of that was down to the repositioning of large pension funds and institutional investors who were rebalancing their portfolios, which meant selling some of their bond holdings and moving into equities, which caused it sort of muddied the waters a bit into the end of March. And we did wonder whether we would see the rally continue into April, and we have. I mean, it has had its moments, but we are still up. And there are some people, what's quite interesting, there are some people who are perhaps very bearish who are now starting to wonder whether we've already seen the bottom of the market. But as I'm going to tell you in a second, there's quite a few indicators to say we could still have more trouble ahead. If I just start with one, the VIX, for example, the fear index, the VIX, is still up around 45. That is still historically very high. I mean, we would like to get down towards the 20 level, which is about the average for the VIX, for us to have any confidence in the level of volatility starting to fall. We're going to start seeing some big swings, or we will still continue, I should say, seeing some big swings. And in fact, despite the rally yesterday, we saw US markets sell off right at the end of the day. They gave up some really large gains. At one point, they were a couple of percent up, as much as 3% up on the day, and fell and closed in the red. Now, that was one of the biggest intraday falls at the close that we've seen since the financial crisis, and ominously that was in October 2008. So we keep having these parallels back to the financial crisis, which will always be should make investors slightly cautious. But we had the rally, we've had a bear market. Are we still in the bear market? Is this just a bear market rally? Well, one of the things that is also worrying about this rally is the volume has been fairly poor on the upside. So what I mean by that is when the market has been rallying, then the amount of trading that's going on that's driving that higher has been far lower than the number of people who sell when the market collapses. So the up days are looking like they're lacking a little bit more, or a little bit of conviction. So that can be a sign that we could be in for some uncertain days. And it also can be a sign that there's a lot of short covering going on. So that means where people have been placing bets, they've been shorting the market, so they're betting the market would fall. When it starts to rally, they have to unwind those bets. And when they do that, it tends to fuel a rally, what they call a short squeeze, and push the market much higher. Now, one of the other reasons we've started to see the market pick up is likely because there are value hunters out there. So people are looking at valuations for equities and starting to look at them compared to history and thinking they're far more attractive now than they were certainly in recent history, and have started to sort of dip back in. We've certainly seen professional investors, institutional investors start doing that. But the question that you must ask yourself is around price to earnings and looking at those price earnings. So they look at PE multiples, they call it, which tells you the value you're getting. And they compare that to history, but we're also doing it, they're looking at price versus forward earnings often. And of course, in an environment like this, how can you guess or predict what the earnings will be going forward, especially when we're in this period of lockdown, especially where businesses are being forced to close by their own government. So how reliable are those predicted earning figures? And if you're basing your valuations on those earnings figures and actually going in, then that may be a bit of a trap. We just don't know. This could have been the bottom that we saw recently, but there are still plenty of signs to suggest that everybody should be careful rather than piling in. One of them also being is breadth. So you heard me talk about on the show about the number of stocks that are joining in the rally and pushing back above their own recent averages and showing some strength relatively to recent performance. So we're seeing breadth improve, but not significantly. So it starts to suggest that we might not necessarily be near the bottom. We may have a revisit. We just don't know. If that keeps improving, which I'll talk about on future videos, then it may give people the confidence that we have seen the bottom of the market. The other thing that I just want to mention is something called a death cross. Now, a death cross is when the 50-day moving average of an index falls below the 200-day moving average. So if you think about a line that's drawn along where it's averaging the past 50 days price moves, then that is a shorter term indicator than the 200-day average. When that line crosses below the 200-day, it forms a cross. And now that's meant to be a sign that things have taken their turn for the worse, and you might get further falls going forward in equities. Of course, we've had such a steep decline in equity markets. We already know that things are pretty terrible, so it hasn't been that much of a warning about the size of the declines we've experienced. But if you go back through history, then you can see that the death cross has tended to show that equity markets could fall another 7% once it's formed. It's not 100% reliable. That's the problem. I mean, we've had 4 death crosses since the lows of March 2009, and it hasn't stopped the general upward trend of markets, even though we've had some pullbacks. But if you look at other markets, in Asian markets, for example, we've had death crosses form that haven't actually been followed up by any losses on equity markets. So it's not necessarily reliable, but it's one of those things. It is not necessarily a good omen going forward. Now, when we take into account March, the picture isn't as positive. So if January, February and March are all negative, then that's happened on 7 occasions in the past. Now, when it has been negative January, February, March, what we've seen is on 6 occasions, the year end, the full year return ends up being negative. And of course, this January was negative, this February was negative, and in March, the S&P 500 fell 12.5%. So it again is another poor omen for the rest of the year. I'm talking about the S&P 500, but of course, what tends to happen in America tends to happen in the rest of the world. But having said that, there have been some interesting signs this week where we've seen, say, UK markets be up and US markets fall. And we've also seen that in Europe. So we may be starting to see some slight divergences in equity markets on geographical locations. I wonder whether that will actually continue. Now, going forward, we've got to get a lot more economic data. All the economic data we've had at present has been based around stuff that's been happening pre the coronavirus lockdowns. And some of the predictions are pretty dire for the economy and the contraction we're going to see in the latter part of this year. We're seeing predictions of 20% falls in economic activity in later on this year, which is obviously almost unprecedented. I mean, Donald Trump has come up with a plan of how he's going to get the US economy going again, and it's based around the idea of letting those smaller towns that haven't been impacted as much by the coronavirus starting to get back to business as usual before the major cities do, so therefore trying to get the economy ticking over again. Markets have quite liked that and have actually rallied on that news. And the other thing that markets have rallied on is the flattening of the curve of the death rate for the coronavirus, particularly in Europe. But of course, ultimately, it will come down to the economic fundamentals. Dividends are a big story at the moment. So they're almost by the hour, companies are announcing that they're actually cutting dividends or that they're not actually going to give a dividend at all. So income investors are going to start to be impacted by this, where they'll see their income hit. Now, 80/20 investor members will receive this week an update to our investment trust income heat map, which basically looks at all the income producing investment trusts out there and looks at the reliability of their payouts year on year, their ability to keep growing it. And crucially, we cover the period that goes back to the financial crisis, when obviously most companies had to cut their dividends then, and investment trusts are able to smooth their income payments. So there are investment trusts, I should say, that have managed to maintain their payments throughout history, even during the financial crisis. So having just updated that data, I can say there are some interesting investment trusts. If you want to have a look at that piece of research, then you can just take out a free trial of 80/20 Investor. Now, the thing on the S&P 500, if I want to give you some indicators to look at, 2,800 would be an interesting one. If we break above there, that could set us up to have quite a decent extension to this rally. I mean, we're up towards 2,750 at the moment as I make this video, and we could push higher or roll over, we just don't know. But on the downside, still look at that 2,450 level. If we go down below that, that could be a very bad sign indeed. And one thing I just want to finish on, we were talking about last week absolute return funds not performing in this market, and I mentioned the perfect ISA portfolio that I produced for 80/20 investor members. I produced it about 5 years ago and came up with an asset allocation. It didn't matter which funds you picked, it was more about the asset allocation, and that had produced a positive return in every tax year for 19 years in a row. I mean, after the point I made the portfolio, it continued to do so for another 4 years. 2020 was the latest year, and I can confirm now that yet again the portfolio made a positive return, even though the FTSE 100 was down 20% in the 2019-2020 tax year. So that means the 80/20 Investor Perfect ISA portfolio has made a positive return for 20 tax years in a row. And not only that, it has outperformed the FTSE 100 over the entire 20-year period. In fact, it has produced twice the amount of return that the FTSE 100 has. So again, if you want to have a look at that, you can take out a free trial of 80/20 Investor. So before I finish, the quick mention on the pound. The pound is now still hovering around about $1.23. We had about a weakness after Boris Johnson went into hospital with the coronavirus, and so people felt that perhaps the UK was going to be slightly rudderless, so the pound was sold. As I make this video, then the pound has steadied slightly. I mean, that is still an ongoing story, so we'll have to see what happens going on into the next week or two. Now, there won't be a midweek markets episode next week because of the bank holiday weekend, which means there'll only be 2 or 3 trading days between this episode and when the next one would have been. So we'll be back in 2 weeks' time. So as I said, keep an eye on those equity markets, those indices I said, keep an eye on the economic fundamentals, and also do keep an eye on bond markets. They've steadied of late, which is a positive sign. Gold has still been creeping up, so bond and equity markets are still sending mixed messages alongside gold as well. So if you want to get hold of me, you can do so the usual way, Damien at moneytothemasses.com, the Twitter, money to the masses with the number 2. Of course, you can get us on Instagram, and do join our Facebook group. Go to facebook.com/groups/money to the masses.